and yesterday was a gap down with a big red candle. So I think next couple of days, IT as a space could be under pressure, but it's a subdued opening for today, so nothing much.
Okay, all right. I mean, a big crack yesterday as well as far as IT services index goes. And I think maybe part of the reason, of course, was that US services PMI number, which was a bit of a shocker, a first decline in a couple of years. Well, I think we've got the first rates which will start to appear on your screen. Anytime we look at the indices, and we'll look at the broader market, etc. So it's, I mean, neither here nor there. It's not decisive, but tentative. So 22,530 is on the Nifty. So a little bit of green, good to see. Nifty Bank about 0.25% higher, 48,800 nearly, round about there, about 1/3% higher in the Nifty Bank. The Nifty is absolutely flat, nothing on it. The mid-cap index is again flat, but not really showing anything meaningful up or down. And I think it's a more two-way kind of market, at least at the word go, with equal number of stocks which are higher and lower. But 13 points on the Nifty now, so 22,570 is what we have. Rima.
IT perhaps is again the sector which is under pressure today. The Nifty IT index is opened with a cut of about 0.5%, and now the Nifty IT index is down for 12th session out of the last 13 sessions. So it's been a one-way slide for Nifty IT over the last 2 weeks. TCS is down more than about 0.5%. HCL Tech lower by half. So that's a weak pocket. Top Nifty loser today is L&T. That's got a cut of more than 1%. You've also got cuts coming through in Hindalco, Titan, Tata Consumer, SBI Life, Sun Pharma. These are some of the notable losers. On the way up, it's M&M higher for the second day in a row. It closed up with a gain of over 1% yesterday on positive brokerage commentary. It's followed it up with another 1% gain. This week, it's seen in just 2 days up nearly 2.5%. Shriram Finance is also inching up. So that's looking up. Private sector banks are coming in for buying this morning. ICICI Bank, Kotak Mahindra Bank on the buyers list. ONGC, which fell yesterday more than about 2%, has rebounded partly. So it's a partial rebound on ONGC, a gain of close to about 0.2, 0.3%. Trend is making its way higher. Getting noticed, up more than 0.5%. But I think it's M&M on the way up. Once again, 1.3%, and on the way down, IT is again on the back foot.
Well, that's right. A few stocks that are buzzing around. IRDA, because of that fundraising plan, that's up close to 3.5%. Some of these banking names on the hope of some kind of privatization, I think, as well, they are moving up. You have Central Bank of India, Bank of Maharashtra. Some of these smaller PSU banking names have moved up. Welspun Specialty, they have announced the rights issue with the dates as well. So that's one stock that's up close to 3%. Last few sessions, it's been moving from circuit to circuit. So Welspun Specialty is another one. Texmaco Rail, they've done a tie-up, with a Polish company, I think, if I remember correctly, Novoma Forge. So that's why that stock is up and about in today's trading session. So good move is what we're seeing on that one. Varun Beverages, after the big pullback that we saw in yesterday's trading session, stock is still down more than 20% for this year. But yesterday's trade, it ended high with a gain of close to around 5%. In today's session, it's giving some part of that up. And as Abhishek said earlier today as well, SBI Cards, he wasn't too impressed with the updated performance. That stock opens up soft with a cut of close to around
There's also a small dividend of 2.5 rupees. So it's also gone ex-dividend by 2.5 rupees. But I think the fall is a little bit more.
Yeah, a little bit more than that. So it's mildly negative if you take into account the point that Rima's putting about the dividend. Just one positive today is that the Nifty Bank, after a while, has made a higher high. Last 4 sessions, it was making a lower high. So today's high is better than yesterday's high. And since the IT index is a little bit off color, I think the Nifty Bank will have to take the mantle on for the bulls if we need to pull back from here on. Prashant.
No, absolutely. And, let's just hope that some stability sort of comes through. And it's not just like a bit of a holding pattern and then there's another big leg down which starts to appear, which has been the case. Last week was not bad actually, but this week so far has been pretty poor for those who were hoping that there will be some recovery. So 22,560 or so is where the Nifty is trading at. Maybe just a brief look at any other names with volumes which are coming up. Tata Investment Corp is one name which has actually got huge volumes for this point in the day. It's back up about 6.5%. So that's essentially it's like a private mutual fund, if I can call it. I don't know if that's the right way to describe it, but that's a Tata Group company, holds high quality stocks in the portfolio and invests their own money. Credit Access is up about 5.5%. So that's trying to recover a little bit. That's again an MFI name which has been sort of swinging between 800 to 1100 levels, but not being able to hold on to higher levels. There is Hitachi Power India, which is up 2.5%, nearly just under 12,000 rupees right now. Z is up 2%, about 98, but it's got some volumes, and that's why I mention it right now. So that's it. Godfrey Phillips is up 1, KRN is up about 2, IREDA is up about 2.5%, 2:1. Almost exactly 2:1 advances to decline ratio at this stage. Let's get in our market master for today. We have Venugopal Mangat. He's joining us to take some questions. Venugopal, of course, is Chief Investment Officer, Equity at HSBC Mutual Fund. Venugopal, great to have you with us here. Good morning. Prashant this side. We spoke recently, and of course, I mean, even from there, markets have come off very sharply. Yes. It's just been a one-way slide. Broader markets, of course, still looking pretty weak. We had Gautam Dugat of Motilal Oswal yesterday with us, and we were just comparing long-term, what does the small cap and the mid cap indices at an index level trade relative to the Nifty and where they are now. So going by historical sort of gaps, it would seem that both the small cap and mid caps at an index level still hugely overvalued. If you just go and look at history, 20-year histories. Just your thoughts to begin this conversation there.
Yes, good morning, Prashant, and thank you for having me on the show. Yes, I think from a historic perspective, small and mid caps still look a little expensive, but I wouldn't say that it's just the small caps and mid caps that are expensive today. I think many of the large caps, including the IT names that you were speaking about just 10 minutes ago, and maybe even many of the other names, consumer names, are still expensive. So I don't think it's only the small and mid caps. The other thing that I would want to say is that we are in a structural expansion for the economy, and given the reforms of the last decade, I think the platform is set for the smaller companies to really grow much faster. And in that sense, for the next 7 years, as the economy is expected to double in terms of size from a 3.8 trillion to a 7 trillion plus by 2030, the landscape of the market is likely to change drastically. And by 2030, I would think that some of these small companies, especially in the discretionary space, discretionary consumption space, manufacturing space, etc., would multiply significantly over the next 7 years. So that's where the money is likely to be made. Even though the valuations look a little expensive as of now, that's the case across the markets, and you're seeing the correction therefore. So I think this is a healthy correction. We've already seen more than a 20 to 23% correction in the small cap index. Stocks have corrected 30 to 50%. I think that's a fairly strong correction in a good expansion cycle. My sense is we are getting close to the bottom. I think it's a good time to invest, much better than what it was maybe 6 months ago.
The high was made in September, so it's been quite a fall over the last couple of months, but we're closer now to the bottom. So at these levels, if one needs to construct their portfolio, tell us top down, how much would you allocate to financials? Because I see recently HSBC also launched a financial services fund. So how much would go into banks, NBFCs? Is that a space that looks attractive? Insurance? Make a portfolio for us if you have 100 rupees of incremental money to put to use right now.
Yeah, across the market, if I have to look at sectors, I think consumer discretionary is a space which is, like I just mentioned, is I think bottoming out. So many of the stocks that we were looking for, to invest over the long term for a long period of time are now coming to a reasonable level. We believe the interest rate cuts and the SOPs that have been given to consumers should benefit over a period of time. With a lag, it should improve consumption trends. And therefore, that's a good segment to be in for the longer term. Of course, I'm talking about the next 3 to 5 years or even more, because we are long-term investors, and I think the opportunity is to invest for the next 5-7 years. Similarly, I mean, we've launched the financial services product. We believe strongly that the non-lending space is likely to expand significantly. The number of companies today you see in the market in the listed space within the non-lending part of the market is limited today, but I think over time that is going to increase. We've drawn parallels with what happened in the US market from the 1980s till now. The US GDP grew about 10 times from 1980. It was about $2.8 trillion in size. Today, it's more than $28 trillion. And during the same period, the financial assets have grown within the country, has grown more than 20 times. And we looked at the non-lending part of the S&P 500, the top 15 companies, and we found that those have grown in terms of market caps very significantly over the last 25 years in this century. Drawing parallels from that, I think we are in the starting phase of an expansion in that non-lending part. So I would definitely want to allocate money there for the longer term. Of course, stocks are correcting there. In the near term, I would agree with many others in saying that the banking space looks a little more attractive in terms of valuations. But there again, I think there are points that you need to consider before really taking a longer term view, given that the net interest margins are probably at a peak and the asset cycle is at its the best in a long time, and credit growth is yet to pick up in a big way. So till the time you have confidence on the private capex cycle, I think credit growth is likely to remain sluggish, and the retail growth is also, the regulatory pressures are there to not grow it beyond the point. So in that sense, I think credit growth will continue to remain sluggish for some time, and the NIMs and asset quality is at the best. So I don't think you can really say that they are structurally, therefore, very attractively priced. But on a relative basis, yes, that's a space that looks better in terms of valuation.
Hi, Venugopal, and good to see you this morning. The other point from the banking as well as the financial names is the FI's largest holding is in these names. And they have been selling lock, stock and barrel. You thought 2024 was bad. Well, just take a look at the start of 2025. What's your view on this FI selling that we have seen? One would argue their holding is at the lowest we've seen in multiple years, but it's just not stopping. Yesterday, we saw closer to $1 billion in a single trading session. Your take on this?
Yeah, I think the foreign institutional flows have gone against India and possibly against the emerging markets from September end. I think that's when the market started building in the expectations of Mr. Trump coming to White House. And I think with those expectations, the dollar index started gaining, the bond yield started moving up in the US, expecting inflationary pressures with tariffs and retaliatory tariffs. All of that, to my mind, has played out. And in this period, I think China has also been trying to revive and recover to some extent. I think there are some positive spaces there, and valuations are definitely more attractive against most other countries. In this period, we've also seen the Magnificent Seven in the US really put more money into AI, and a lot of noise around that, and that driving markets further. So I think against a slowdown in India and high valuations, probably the foreign investors are seeing better trends outside, maybe a stronger growth market in the US, maybe value in China, maybe some safe haven assets outside that. So that's probably what is playing out. My sense is the brunt of selling, or the larger part of the selling, is probably done. I don't think the ferocity with which the selling took place over the last 3 or 4 months will continue going forward into 2025. I think at some point, and my belief is the markets are likely to bottom out soon. And at some point, the foreign institutional investors, given that they are so underweight against the index, will need to relook at India.
You did mention the US, etc., Venugopal. So my question essentially is, do you think the top is in for US tech? Simply, and if it is in and we see meaningful pullbacks, will it have an impact here in India?
Yeah, I'm not an expert on the tech sector, but I think what I'm hearing from a lot of strategists also is that the spending that has gone into the IT space, especially for AI, has really peaked and or is extraordinary. It may not result in the results that one is seeking. And to that extent, I think there could be challenges for that space. My sense is the valuations also overheated there, and very sooner than later, I think that market is also likely to peak out, in my view. But it all remains to be seen as to how the Trump administration takes this forward, and without challenging inflation or without stoking inflation and or impacting the growth in the economy, does what he wants to. The IT space, however, I think the AI is clearly the next wave that we are seeing across the world. So it will continue to be a buzzing space. The stocks there have become expensive and have done extremely well. So maybe you could see a peak soon.
All right, Venugopal, thank you very much for joining in. We'll continue chatting about the market, focusing on emerging markets, the kind of selling we've seen from FIs in India in particular. Charlie Dutton, head of emerging markets and Manulife Investment Management, is now with us on the show. Charlie, thank you very much for joining us in the studio.
Thank you for having me.
Well, so the first question is this selling spree by FIs. Is money moving out of India into China? What's driving this kind of selling pressure that we've seen?
So it's a very interesting question. I think when we're looking at this at the moment, it's very much not a case of India into China. It's interesting to see that the large amount of the China move that we've seen so far year to date, and certainly into the end of last year, was very domestic driven. So international investors have not really been moving from India to China. When we're looking at India itself, I think the selling pressure here really has come about from the tremendous bull market which we've had in India over the last 3 years. And as we went into the end of last year, valuations on India became stretched. So all it took was a slight slowdown in the credit markets, in the credit cycle, in loan growth, and some earnings expectations, and that led to money coming out of India. I certainly don't think the bull case for India has changed, but I think with all long-term bull markets that you have, and that's what we believe is happening in India, you will get these pullbacks and a reset, and I think you'll see a return of FII, certainly in the second half of the year, once those valuations get back to those long-term averages.
Okay, all right. Hi, Charlie, good to have you, and good to hear that, in terms of the FI, it appears that valuations got a little bit excessive and earnings growth didn't pick up. So you're expecting the FI flows to return back to India. What do you think in terms of, this argument about India versus China, though? As you've said, is the money is moving out of India, but it's not moving into China.
Yes.
Do you think that in their pecking order now, given the valuations of China, given the moves that they've made, in terms of tech, in terms of the way they're producing their cars, even the moves they made in the pharma space, do you think that China actually is now the game in town, because still last year, India was the only name in town that we're looking at. It was the TINA factor. There is no alternative. So in preference-wise, where do you think your FIs are looking?
I think this is what's so fascinating about emerging markets now. When I started doing emerging markets, and certainly over the last decade or so, if you took a call on whether you wanted to invest in emerging markets, it was whether you were overweight or underweight China. It was very simple. China used to be 40% plus of the emerging market index. And now actually its weighting within the emerging market and compared to China, compared to India, is actually very similar. So I don't think it's become an either or in that sense. I do think when you're looking at China, though, when you're looking at three components which really drive a bull market, it's valuation. So starting valuation's got to be cheap. You've got to have under ownership, and that's what you've got in China at the moment. And then you have an earnings inversion. So when we see what's happened to China tech over the last few months, it's that implication of an earnings inversion which is really driving it. Because of DeepSeek, because of the belief that AI and cloud growth is now going to come back in force, that's what's driven that growth. Now, for there to be a longer-term China bull market, we need to see a significant change in consumption patterns in China. So saving rates in China at the moment are record highs. That's because there is no confidence in the Chinese economy at the moment from the consumer. They used to put money into property. That was an asset which continued to appreciate in value. That gave them confidence. Then they went into the markets and spent that. Property market in China, as we know, has been in the doldrums, and there's no obvious return of that. So until we see that return in consumption confidence, I still think there's a good balance between China and India.
Just your thoughts on, I mean, Alibaba, by the way, was down 10% last night.
Yes.
And a lot of talk whether this is, we've had lots of false starts in China over the last 3-4 years, right?
Yeah.
But those starts, while you're in it, seems like the real thing, because those rallies have been 50-60% in some cases. Yeah. But do you think this is different now? And, we got the government behind with some fiscal, some monetary efforts. And this is AI bit as well. And of course, that shines a spotlight on all the technological prowess that China has, generally speaking.
Yes. So great question. I think on that side, historically, China's had these very strong bull markets when they've come out with the fiscal and monetary bazooka. What we've got to understand with China is that until there's a significant change, the overriding policy direction in China is around renminbi stabilization and making sure that renminbi can become an international currency, potentially replacing the US dollar to some extent. When you have that policy in place, it means your ability to have a strong fiscal or very high fiscal or monetary stimulus is limited. Therefore, it's going to come down to more individual aspects within the market. So when we're looking at China, it's very much specific stocks, specific sectors. There is not going to be a general kind of consumption growth or economic growth in China of the likes that we've seen previously at this point, unless you get a significant shift in that policy change.
The other big question, of course, is the US, right?
Yes.
Lots happened in the last, 1.5, it seems like years with daily headlines, etc.
Yeah.
What does it do? You look at emerging markets closely. What does all of what the Trump administration is doing or wanting to do mean for money actually going into EMs? Because, I mean, the signal is that, everything should happen in the US.
Yes.
Forget the rest of the world.
Yes. Yeah.
What's your sense?
So it's interesting. I think we're going to definitely have trade wars or tariff implications 1.0 and 2.0. So 1.0, I think, was a genuine reset, and the Biden administration continued this to some degree, of too much was being imported into the US, not enough was being produced domestically, we need to adjust. And we've seen significant supply chains adjust around the world as a result. At this point, and it's always difficult to tell with Trump, but at this point, the indication is that tariff wars 2.0 are more of a lever rather than anything else. And so what we've seen so far, the tariffs that Trump has come out with on Mexico, what it's come out with on Canada, to some extent what it's come out with on China, has been a bargaining chip for other aspects of the economy or for geopolitical considerations. So it's uncertain at this point as to whether we're actually going to see those tariffs carried through. Now, we've had some headlines this morning around further semiconductor implications and regulations and restrictions on particularly exports out of Europe and semiconductor equipment coming out of Europe and coming out of Japan going into China. So I think you're going to continue to see that aspect going forward. Where I think it's very different.
Although some are convinced that with the majority that he's got and
Yes.
Actually, if anything, it's going to be tariffs 2.0 is going to be even more forceful and more decisive, and he really wants to do it as well, more well thought out as compared to what we saw in the first term.
I would agree with that to some extent, but I also think a key KPI for Trump is what happens to US stock markets. He's going to want to start at a certain level, he wants to finish at a much higher level with the US stock markets.
Is that possible?
Well, this is the point. So I don't think it's possible to have much higher US stock markets if you have inflationary regulation coming through or inflationary inputs coming through. So if you come through very aggressively with very high levels of tariffs, that will be inflationary. That will lead to higher US interest rates. And therefore, what is the possibility of US stock markets going higher on the back of that? So I think that could act as a natural cap to the level of tariffs that Trump is coming through.
So Trump will use it more as a negotiating tool, is what you're factoring in?
That's the indication at this stage. But as I say, the Trump policy, as we know, can be quite volatile.
Can US be down meaningfully when EMs be up? Can the if a top? I mean, some are already talking about whether a top is in for US tech.
Yes.
If the US were to pull back meaningfully, can money, can EMs do well?
Of course, yeah. I mean, put it this way, year to date, if you're a over the last decade, if you're a global asset allocator, like, where would you have made money? Like, you didn't need to put money offshore from the US over the last decade. What we would say there is that the valuation differential between EM and DM now is at its largest point that it's been for many years. Therefore, when we're being approached by our global clients, they're very much aware and cognizant of the fact that they have a large overweight in the US and they tend to have large underweights in emerging markets. You get a move like we've just had in India over the last few years, a move like we've had in China over the last 6 months. That concerns asset allocators. So I think you'll see a natural drift of assets from developed markets into emerging markets.
So simply put, at Manulife, what's the call now on US markets from here on emerging markets, and within emerging markets, the preferred bet? And why do you think India's FIs will make a comeback into Indian markets in the second half?
I won't, as the head of emerging markets, I'm not going to comment on the US at this point. But what I would say is that when we look at emerging markets at the moment, we're very constructive on emerging markets going from here. As I mentioned previously, historically, when you took a view on emerging markets, it was whether you were positive or negative on China. I think what's fascinating with emerging markets right now is that you could allocate individual capital to India, you could allocate individual capital to China. If you look at what computational supply is coming out of the likes of Korea and Taiwan, that is again on its a standalone investment case on its own. And within LATAM, we're also very constructive of individual companies within Mexico and also within Brazil. So I would say that from a valuation perspective, that emerging markets and Manulife are very constructive on emerging markets at this point going forward. And we'd certainly be nominating more capital.
And within emerging markets, your preferred destination for capital?
So we are very much a bottom-up stock picking company. So we don't start with a top-down. This is how much we should have in individual countries. So the opportunity set we're seeing at the moment is very much based within India. We're now thinking that there's some really interesting, particularly in the mid-cap space, where we've seen a lot of pullbacks.
Could you name a few themes in India that you like?
Yeah, so there are a couple of themes I'd like to go through there. I think the internet platforms in India, the duration of growth that you have within the Indian internet platforms is quite extraordinary, and I think that's something we'd be very interested in. So whether that's the food delivery side, whether that's the online travel side, whether it's the fintech side, those are all businesses that we're familiar with, and we'd be very positive on those on a longer term basis. And I think this pullback gives a good opportunity within those individual areas. The other thing we're very positive on is actually the IT outsourcing within India. This is a sector which had very strong double-digit growth many decades ago, obviously slowed down more recently. We actually think it's a very big positive response to AI and the introduction to AI to companies around the world.
Yeah.
You can imagine if you're a mid-cap company based in Europe or the US, you have an IT department of 10 people, your CEO comes to you and says, how are we implementing AI? You don't have the resources to do it. Right, well, I'll go to some of the large Indian IT outsourcing companies, and we're actually seeing some inflection in their earnings growth on the back of that as well.
Okay, consumer internet platforms and IT outsourcing as a theme. Great chat, Charlie. Great that you could come down to our studios, and I hope it's the first of many.
Of course.
I really appreciate it.
I'd love to come back.
Thank you.
We look forward.
Great. Thank you.
All right, well, we'll just take a quick commercial break here. We've got the market, which is steadier. But don't get too excited. It's just 50 points. 22,600 plus is where we're at. Market breadth is positive. Some 3:1 in favor of advances as things stand. We'll come back with Neeraj Sharma of OneSource Specialty Pharma. That's a chat you don't want to miss, coming right up in a bit.
Welcome back. Well, let's turn our attention to OneSource Specialty Pharma. The stock has been a little bit under pressure in the last 1 month or so. The GLP-1 demand is expected to be a big growth driver for the company. Also, they plan to double their revenues, improve their margins in the next few years. To discuss this, the outlook in terms of growth, we're joined by Mr. Neeraj Sharma, the CEO and the Managing Director at the company. Hi, Mr. Sharma. Good morning, and thanks a lot for joining in. You know, I recall when you joined us the last time around, you told us have some patience, wait for the results, and then we'll talk more in detail. So that's the opportunity now. The EBITDA number has been improving on a quarterly basis. So Q4, do you appear that you're on track to do around $20 million approximately? And in the next 3 years, do you see that annual EBITDA number move to the vicinity of around $130 million? By FY 27-28, should that be the target?
Yes, indeed. So as we have said, as in this current fourth quarter, yes, we have given a guidance of in excess of 20 million our exit run rate, and in the next 3 to 4 years, we have said we'll be a 400 million revenue company with a 40% EBITDA margin, and a lot of it is driven by our drug device combination biologics business, which is a very strong revenue and EBITDA driver going forward for us.
So just extrapolating that number, $400 million of revenue with 40% margins means you'll do around $160 million of EBITDA by FY 28. Bang on?
That's it. Yeah, that's what we have said. In the next 2 to 4 years, that's exactly what we are aiming to do.
Okay, all right. Let's talk about capacity then. Could you tell us what is your current capacity? I believe you're increasing capacity as well. So what is the total capex you're going to be incurring? Oopsie. Okay, all right. I think we'll wait by, to get the management back. But as Mr. Sharma says, currently they're doing a quarterly run rate of little around 15 to around $18 million approximately. That number will move to around $20 million in Q4. And in the next 3 years, that run rate on a quarterly basis from $20 million in Q4, the quarterly run rate will move to around $40 million. All of this in the next 3 years or so. So we'll wait for the management to join back in. But by the way, the markets, at least we have a fair bit of green on the screen. Quite a few stocks trading in the green. The markets as well, the headline indices are trading well, but the breadth of the market is positive. You have 1,800 stocks that are advancing, which is good news as we speak. And SBI Cards, the stock had started off mildly in the red. That's seen a bit of a U-turn because their spends were better than the industry. And the market share on a month-to-month basis has improved as well. So SBI Card, after starting off in the red, that stock has moved into the green. So we'll keep an eye out on that one. By the way, from the broader markets, actually, a few stocks have moved to the high point of the day. Chambal Fertilizers, big move is what we're seeing on that one. The stock had started off more or less flattish. Now it's up around 3.5%. Abbott is the other one as well that's moved higher. And the two new entrants into the Nifty, you'll be having Zomato as well as Geo Financial. Yesterday, the markets were quite nervous. So that's why we did see both those two stocks ended in the red. But I think both those two now at the high point of the day. Mr. Sharma is back with us. Mr. Sharma, you were telling us about your capacity addition plans. Current capacity, where is it headed? And what is the capex plan?
Yeah, so the current capacity, we are at 40 million cartridges, which is, as I said, among the highest in the industry today. And we are actually going to take it to anywhere, excess of 200 million cartridges. And this will be over next 3 to 4 years. And in fact, to achieve that, we have already said that we will be investing about $100 million in new capex in this time frame, and significant part of this new capex will be on the cartridges and the drug device combination expansion.
Okay, let's get to funding of that. And could you tell us what is your current net debt number? Because if I look at the interest cost for the past quarter is around 46 crores on a quarterly basis. So if I extrapolate that number, it'll come to in a vicinity of around 180 to around 200 crores of interest costs in an annual basis. What does this mean about your net debt currently? And given that you have a capex plan of around $100 million, where is this number headed?
Sure. Actually, if you saw that we have actually significantly reduced our net debt, we brought it down by half, almost from 140 odd million to 70 million end of the last quarter, which is quarter ending December. And, and we expect, because as I mentioned to you, the kind of EBITDA numbers which we are already generating and anticipate to generate over the next 2 to 4 years, we expect most of this capex will be through our self-accruals already. The cash we'll be generating ourselves, and there's also customers who are participating in our capex program. So from a debt point of view, we have said we are ending this year less than 1 time debt to EBITDA, and we will actually be doing we are going to be a net debt free company in the next 3 to 4 years.
All right. What does it mean in terms of interest costs, sir? Because as you're saying that the net debt number has come down by half, but if I look at your quarterly run rate in terms of the interest cost, that's still at around 46 crores. So
we have, just to let you know, we have significantly reduced that in third quarter. You saw that we had raised almost $100 million of primary investment before our listing, and we have used a significant part of that to reduce and retire our high-cost debts. So therefore, going forward, you will see our debt servicing cost coming down quite dramatically.
So on a quarterly basis, it comes down, say, to around 20 crores per quarter. Should that be the run rate we should look like in terms of interest costs?
So I don't have the exact interest cost number, but I said the total debt has come down by half. So we expect the interest cost. In fact, the interest cost will come down lower because simply because our debt servicing percentage also is coming down. Especially you would have seen our ratings have gone up quite significantly by rating agencies. So all that is going to have a positive impact on our debt servicing.
Okay, all right. Final question before we let you go. GLP-1 is expected to be a big growth driver for you. And you've indicated that you have got a fair bit of inquiries as well. What about conversion of these kind of inquiries into business, revenue potential, and from which geographies are you seeing higher traction?
So GLP-1, seriously, we were the pioneers as CDMO in this area, and we still feel we are, from a CDMO space, a very, very significant player. In fact, we already have, 20 plus customers in this area, and these customers are the global who's who in the generic space. So we will be a very significant player in this market as the market forms. We already are, our first customers are launching liraglutide in the major markets this year. And when, semaglutide, which is the largest GLP-1, which comes off patent in key markets like Canada, Brazil, starting 2026, we will continue to expand, and our revenues will continue to show that. So it's a very important drug, and OneSource will be a very significant player in the GLP as the generic market starts forming.
All right, we'll chat more. Thank you very much for coming on the program, sir. Appreciate your time here on CNBC-TV18. Thanks indeed. Well, let's put the spotlight on the Indian healthcare space now. Indian hospitals are eyeing significant capacity addition. There are also, of course, lots of business houses which are making it clear that they want to enter the hospital space. We've heard announcements, at a high level from groups like the Bajaj Group, from the Adani Group, and others, of course, also indicating that they are interested. What does this mean for the existing sort of supply-demand dynamics? Let's bring in Ankit Thakur, who's CEO at Jupiter Lifeline Hospitals. Viren Shetty is Executive Vice Chairman at Narayana Health. Gentlemen, good morning. Great to have both of you here. Thank you very much for joining us. Viren, if I can start with you, Prashant this side. Sort of broad thoughts first up. Private equity and financial players have always been interested in this space. It's steady growth, lots of demand. But you're seeing more and more industrial groups, conglomerates wanting a piece of the pie. What do you make of it?
It's a good thing. This is a huge market. We are one of the fastest growing markets for private healthcare in the world, and the most underserved population in the world. The more people that are out there making hospitals for people that serve the community, it's better for the country, right?
Obviously it won't be immediate because you'll need to set up, unless of course these groups buy out hospital chains I mean, you know, that's different. But if they're going to set up from ground up, it's going to take time, right? How do you gauge? I mean, of course, there's no question. Demand far overwhelms supply. But what about quality care? I mean, sort of quality health supply, Viren. How do you gauge that with all these plans being announced now?
It doesn't necessarily compromise on the quality of care you're providing. See, the thing is, CapEx is just one of the levers in which you provide, that is adding beds and capacity infrastructure. The other is getting good doctors, getting good systems in place, training nurses. And invariably, you will have a system where the more hospitals there are, the more it naturally brings up the standards for the entire industry. And the fact that there are these very large business houses that are interested in it, obviously it's better for the industry because then maybe it gets more of a sense of organization to the place, and there will be a lot more interest in investing on healthcare as a lot of those input products. So for example, very little medical equipment is made here, very little consumables are made here. A lot of this is brought in from outside. The larger the domestic healthcare industry grows, the more entrepreneurs come in and start becoming suppliers to Indian hospitals. They're not just looking at export markets. So yes, I mean, long term, this is something that would only benefit the industry.
Sorry, my question, and that's a great answer, but my question more to make it clear was from a effective purchasing point of view. I mean, affordable, I mean, you know, the segment of population which can afford treatment at the kind of hospitals that you run, others run, etc. In that context, a lot of this supply starting to come in, Viren.
Yeah. So that's when you start to really get to the meat of the argument, right? The fact is a certain amount of investment requires a certain amount of return. Those of us who borrow from banks, from private equity, or those of us that are funding it out of other balance sheets, you're looking at the return on capital. And the huge amount of investments that come up in land, building, doctors, and so on. If you're looking at it from a 10, 15-year perspective, there's a certain amount that you need to charge to customers to be able to recover that. If you're looking at this from a 25, 30, 40-year perspective even, then it's possible that you are providing something that's of net benefit to the customer, does not raise the overall prices of the industry, and you have customers who are getting quality healthcare at a good price. Whereas if it is the notion that this is something that in 10 years you're going to make a solid return on the investment, obviously you will make your customers pay a little more than what they're used to paying. But those are business choices. There will always be customers that are willing to pay more for the same levels of care. There will be customers who may be a little more price sensitive and will not be willing to pay more. And there is a market for everyone. And it's just that some of us play in certain markets and others that play in other markets.
Ankit, hi, morning. Come into the discussion. You know, we've seen PE investments in hospitals before. Has the fabric of the DNA of the hospital changed after a PE player has come in, to your mind? And if yes, in what way? And also jump in on the argument that how PE players ultimately are in to make, there is a pursuit of profits. They're in to make some money, which could be a conflict with the idea that, you know, healthcare should be affordable for all.
Well, I think for a long time, healthcare has been an apologetic industry. And I think that needs to be addressed and corrected. I strongly believe that integrity and business can both be used in the same sentence. So this whole notion that someone who is trying to make a return, as Viren was saying, is simply not bothered about any integrity or any ethical standard, I think I would like to disagree with. So going forward, yes, with PE coming, industrial houses coming, and the government especially signaling that healthcare could be a privatized industry, a lot of us listed on the exchanges, it is acknowledged that a return has to be made. But at the same time, I think it is also quite clear that the integrity and ethical standards have to be kept high. As far as affordability is concerned, I think the aspiration has to be to afford healthcare through an insurance system. Nowhere in the world a quality healthcare cost is within the reach of an average person out of pocket. So the aspiration for affordability has to be through the insurance procurement. And that is the way we need to look at it.
And have you seen the DNA of hospitals change after PEs come in with deep pockets?
I think each company has a different DNA. We, for one, have never had a PE investor on our board, so I can't really speak a lot with personal experience. But yes, each company will have a different DNA. I would not want to broad brush the entire healthcare and PE sector in this response.
Viren, you smiled.
Let's see.
Do you want to? Yeah, come in.
Healthcare as a public good is a public provision. And there is scope for advanced Western economies with massive tax bases that are able to support a large public healthcare system without the notion of whether this needs to be run efficiently or in a very tax efficient manner. We are seeing in real time the decimation of that business model, both in the Western world, the United States, United Kingdom, where large publicly funded healthcare systems are really lagging behind. The business of healthcare, see, healthcare is a modern enterprise like any other, requires massive investment, billions of dollars in R&D, huge amounts of digitization, huge amounts of work involved in providing very, very specific high quality levels of care that are simply not capable of being provided without a well laid out structure of incentives. You can no more expect the public provision of healthcare as you can the public provision of semiconductors or jet engines or any other modern industry. Now, let us not take away from the fact that people are feeling the pinch that in all parts of the world, the increased privatization of healthcare is causing a hurt on people's pockets. That absolutely is the case. But as with any industry that has large amounts of private sector participation, it opens up different business sectors for different participants to play in. There are those that would operate in a much more cost-efficient, low-cost model, and that will cater to a certain segment of the market. There are certain players that will say we will play to the higher end of the market and provide very luxurious accommodation and very fancy infrastructure, and that is fine as well. There should be different sorts of business models that provide healthcare. Now, PE in the end, like any other fund, if you say private equity, if you say SBI, anyone who's financing this industry is looking for the return of their money. It's just that the sources of capital are very different, and the business model we build around that have to cater to that. So we should not, as Amit was saying, don't be apologetic about the fact that there is investor interest in this industry. As customers, you should celebrate more choice coming in here. And the incentive structure, I'm not saying it will sort itself out. There is sufficient scope for regulation. There's sufficient scope for consumer choice that will create the best options for customers over here. But a busy industry with a lot of inbound investor interest over the long term is better for all of us.
I think that's well put. We could have gone on, but we are short on time. But it's an interesting conversation, which I think we will continue to have. It's a balance, as I think both of you put it. Viren and Ankit, thank you very much for joining us. Good speaking with both of you here on CNBC TV18. I think we'll sort of look at the market for a bit. 45 points higher, 22,600 or so. Mitesh is back with us. Mitesh, just a quick word on the price action. Anything you're seeing? Any trades?
Nothing much on the index, Prashant. To be very honest, I think the first thing which is of concern to me is that yesterday we had a gap down which had a high of 26,668, and the upper end was 22,720. So I think if we get around closer to those areas, I think I would want to take some short positions. So around 22,670, 660 zones. Take a stop about 22,720 and trade on the short side. A reversal will happen once we cross 22,800, but the first stop loss should be 22,720. But on the stock side, there are some interesting stocks to look at particularly from the long side of trade. I have a buy on CG Power, which I would recommend buying with the stop just below 595 for a target of 630. And the other one is a buy on Nestle. Nestle has given a good reversal on the hourly and 2-hourly charts, so buy here. Keep a stop at about 22.10 and look for a target around 22.85.
Thank you. We will slip into a break on that note. On the other side, Manisha will join in to focus on commodities. Welcome back. The Nifty is now closer to 22,600. M&M is the top gainer, up more than 2%. On the way down, the correction or profit booking in Hindalco continues. Hindalco is down more than 3%. But Manisha is now here with us for the latest on commodities. Manisha.
Well, thank you for that. I'm looking at the crude oil prices where we have seen gains for coming in for a second straight day. Remember, it was on Friday that we saw the crude oil prices decline by 2.7%. But the last two sessions, including today, has seen some gains come back. We are trading above $75 a barrel for the Brent crude oil prices. Well, support comes in from the fact that the U.S. is looking to impose more sanctions on Iran oil. That could mean disruption in supplies. The other important factor clearly comes in from Russia-Ukraine conversations. From what we know right now via reports is that European Union will hold emergency summit on 6th of March to discuss support for Ukraine. And on the other side, you have US directly talking to Russia, excluding European Union and Ukraine for that matter. So that tells you that we're not at the end of this conversation yet, and there are way too many factors, and that also has had some premium on prices. The other thing is about OPEC and allies, and all eyes on the March meeting, really, because we are looking at the street talking about withholding 5.8 million barrels per day production to support market. This has been happening for last 2 years now, and OPEC has been wanting to get some of this production back on road, but we have seen 5 postponements come back in sense of rolling off these production. Now, the next one comes in for the month of April, and we will know whether or not OPEC and allies are increasing production in the month of March. That is when that meeting will happen, telling us on what really can be expected in April. The other thing is that many of these OPEC members, whether it's Kazakhstan, Iraq, UAE and Nigeria, have been increasing capacity. So whether or not they will hold on to their agreed quotas that OPEC has allotted is yet another question mark that the street is looking at. And then you also are looking at higher production continuing from US. We already are looking at 13.1 million barrels per day coming in from US, and a record 13.6 is what the targets are for this year. So higher supplies from there as well. More importantly, it is going to be about tariffs, and Trump has reiterated that tariffs on Canada and Mexico will proceed as planned. Well, if that happens, then we are looking at some disruptions, some concerns in the global markets and inflation as well. And that in turn also seems to be supporting crude oil prices, at least at this point in time. What you would want to focus coming forward is the US personal consumer expenditure report that comes in on Friday. And then there are 9 speeches slated from the US Fed officials in this week itself. And that perhaps would tell you on where the economy, tariffs and interest rates are going. So that is yet another thing to watch out for.
All right, Manisha, thank you very much for that. That's commodities in focus. Well, coming up after a quick commercial break is an interesting conversation on the trend of foreign MNCs listing in India. Remember, Hyundai was the big one, and many more are coming up after that, at least in the near future. Cyril Shroff of Cyril Amarchand Mangaldas and Raj Balakrishnan of Bofa Securities India will sort of tell us whether this is a trend which is going to be durable, what are the reasons, the motivating drivers, coming up. Hello and welcome to this special chat. Markets may be down recently, but the current pullback follows what has been a period of exceptional returns for the last few years. Consider the statistics. The mid-cap index CAGR returns for the last 5-year period ending 2024 is 27%. The same number for the small-cap index is 26%. The CAGR returns for the Nifty for the same period is nearly 15%. Well, you'll call that modest versus what the mid and small caps have done, but still higher than Nifty's 25-year return scorecard. The booming markets have set off many new trends in the markets. The question is whether these trends are fleeting or here to stay. One of the trends has been foreign MNC companies listing in India. We've had Hyundai India's near 28,000 crore IPO, the largest Indian IPO ever, which really put the spotlight on this phenomenon. Reports suggest a healthy pipeline as well, LG India being a prominent next one. We have Norway's Orkla, which owns MTR Foods. There has been talk of hair appliances trying for an IPO. Hindustan Coca-Cola Beverages has been rumored to be in the fray as well, and many more. What is the reason behind this interest, and is this durable? Well, we have two gentlemen with us who will bring us the answer. Cyril Shroff is the managing partner of Cyril Amarchand Mangaldas. Raj Balakrishnan is co-head of India Investment Banking at Beaufort Securities. Gentlemen, great to have both of you here. Thank you very much for your time on CNBC-TV18. Mr. Shroff, if I can start with you. First up, is this a departure, what we've seen recently, all this interest, the listing, or it's not really? I mean, it's, because the Hyundai IPO being so large, it's being seen as one. What is your sense? Put this recent phenomenon into some historical context for our viewers. Go on.
So I think this is the beginning of a trend, and Hyundai is not the only one. I think there have been a number of issuances already of similarly structured companies, and there are many more in the pipeline as well. And it is really a reflection of what is happening in the Indian markets and the Indian economy as well. I think the starting point, of course, is the Indian economy being on such a strong growth path with the economic fundamentals, then the depth and the robustness of our domestic capital markets and the ability to list as well. There's also an issue of relative valuation in the home markets of the parent as well as their Indian subsidiaries or the Indian entities. There is a massive delta between the two as well. And it goes without saying that what we are observing is that the Indian market is offering a very high multiples and success at listings as well. And apart from foreign multinationals kind of choosing to list in India, there is also the start of what you might have heard of as the kind of reverse flip or the ghar wapsi of kind of Indian structured businesses, or where the majority of the business was in India, but the companies were registered offshore for offshore listings as well. They're flipping back and coming back to India as well. So it starts from the same starting point of the Indian market is a very attractive place to list, not only for Indians who had gone out and are now coming back, but also multinationals who are choosing to list their Indian subsidiaries over here because there are very, very strong economic and commercial reasons to do so. So it's a trend.
It's a trend, and it's with the start of one, Mr. Shroff, that's what you're saying. Raj, as a veteran banker, I mean, your insights on this. I remember when the Hyundai IPO was happening, we were talking about how in Korea, that business gets about 5 times multiple. Here, of course, I mean, auto companies get anywhere between 40 and 50 times. Is that the big attractiveness, the kind of valuation that you can get here in India? What are your thoughts?
So the way I look at it is that the valuation of the India businesses of these entities is for good reason, which is that the India businesses of a number of these multinationals are growing faster, are more profitable, and probably have a much longer horizon of growth than their home-based businesses. And effectively speaking, so you have this jewel in the crown, so to speak, for a number of these companies, which is not getting the right reflection and the right valuation in the parent company valuation. So we've seen this happen in other sectors around the world. For example, you've had a number of companies globally listing their tech subsidiaries or spinning off businesses in order to try and identify and unlock value. And I see the India subsidiary IPO as a continuation of that trend. So you've got businesses which are growing very rapidly, which are extremely profitable, which are leaders, and the market in India rightly gives these businesses very high multiples, which hopefully will help unlock value for the parent as well.
And you would agree with Mr. Shroff that this is the beginning of a sort of trend, an acceleration, a trend which is perhaps will accelerate going forward?
I agree fully. You've had a number of multinational companies, and I won't take any specific names, which have built extremely strong businesses in India over the last 30 years, but you've seen very few of them listing. And with SEBI having simplified a number of the regulations around listing in India with a few successes, I think what will tend to happen is you'll see boards of parent companies and their shareholders taking notice of the fact that, hey, we've got this great India business. It's something which, our peers in India who have listed subsidiaries, their entities trade at very, very high valuations. So why should we not be looking at this quite seriously?
Are there any other reasons, Raj, apart from the valuation, which you say, rightly so, because growth rates here are much higher, but are there any other compelling reasons?
It becomes a very attractive means of raising capital for the parent, right? So you have a number of these examples. So, for example, Hyundai was entirely a secondary sale. So that money went back, it's hard dollars going back to the parent, representing a return on the investment that they have made in India. Secondly, it also signifies a commitment of the company to the Indian market. And for any company which has got a strong consumer brand, helping their consumers become stakeholders in the prosperity of that business is always a positive as well. And so I think it's a combination of factors. It is a commitment to India. It's a commitment to the Indian consumer, helping make your consumers your partners in prosperity, so to speak, as well as a great way of getting cash back, return on investment back to the parent without giving up control.
Hyundai is now, but the good old Maruti, right, is just a shining example. I think even now, the Maruti India listed entity perhaps contributes, if you do a SOTP, perhaps the bulk of the big driver for the overall Suzuki business is, the Maruti, the India sort of subsidiary in that sense. But of course, we consider Maruti a homegrown business, even though it is an MNC. Mr. Shroff, Raj briefly alluded to the regulatory landscape, etc. as well, and you sort of alluded to that in the first response. Could you expand on that? What is that looking like? Has it become easier over the years? Has it become more welcoming?
Oh, absolutely. And what Raj mentioned, and building on some of my introductory comments, is that what has happened now is that effectively the Indian markets are unlocking value for the world. It builds on the many themes that are going on, Make in India and things like that. The newest addition to that slogan is unlock value in India, particularly when you have entities like the subsidiaries over here where you could access the Indian capital market. But now coming specifically to your question, I think the answer is yes. If you go back in history, exit in India was very difficult. It was very problematic for tax reasons, just the administrative protocol. Now it is so easy to do that. So amongst the regulatory changes that have enabled this is that exit on the market through an offer for sale. Many of these are through offer for sales, have become much easier. The listing norms have also been simplified. For example, the minimum public float that is required above a particular capital size has been reduced in order to enable these, because these are very large businesses that have built up over a period of time. And if the full 25% was applicable for listing, I think the companies would have struggled. So the regulator and the policy environment has been very practical in enabling this by making all these adjustments that were required in order to enable this. Also the corporate governance rules. I think there is an assumption that these sort of companies have better corporate governance, which is why they command better valuations and get higher multiples when they list as well. So the change in and the tightening of and more clarity in relation to the corporate governance framework has also been a contributory factor. So all in all, if I can call it, the regulatory mahal has been sufficiently adjusted to enable these transactions to happen, and now they happen in a jiffy.
No, and I think the depth of the markets as well, right, Mr. Shroff? Whirlpool, for example, wants to. I mean, I think the global CEO was on record last year. It was saying that why not take advantage of the valuations? I mean, they did one round, they're doing another round. And of course, the market is deep enough to absorb that. So there is that as well. What are the size of the opportunity in that sense? Raj, if you want to take that. I mean, if this is we're at the beginning of a long trend, how large is this going to become? Will we see, a couple of listings every year, large ones?
I think it's actually a massive opportunity. If I were to just look at the kind of dialogue that we have, we probably have a dialogue with, several multinational corporations evaluating the possibility of a listing in India, literally 2 or 3 such dialogues every month. So there's several companies which have built very, very strong businesses in India. Now, of course, a decision to list in India tends to be seen as a somewhat irreversible one, or at least something which cannot be reversed easily in the short term. And therefore, people do evaluate these decisions very, very carefully. But I do see this as a trend where you could see not just 1 or 2, but several companies getting listed each year for the next several years, if I just look at the number of MNCs that we are having dialogues with.
Okay, a couple of every month basically is what you're saying, at least in terms of conversations. But of course, they take their time before deciding. Mr. Shroff, I mean, same question to you, size of opportunity before we drill it down to more specifics?
Massive, and by definition, many of these transactions are very large. They're all $1 billion plus as well, just in terms of the ticket size of several of these transactions. So I agree with Raj completely, and he and I probably are part of many of the same conversations as well. And the reason for that is the economic reason is that the multiple that is available in the Indian market is so much higher than in the home markets that it's in many cases it's a no-brainer. And there are many large. I mean, if you just go through the list of MNCs that have large businesses in India and are potentially listable. There it is, and you will get a sense of, there are American companies, there are European companies, there are Japanese companies, there are the Korean company. Hyundai was a Korean company as well. So the economic argument is very straightforward. I think what the multinationals have to get used to the idea is that they will then have to deal with the Indian regulatory environment, and the Indian regulatory environment is different from the home environment. In some ways it is stricter, in some ways it is more liberal, and in some ways it has yet to evolve into a kind of a more mature state. But that is happening all the time. So those are some of the trade-offs, but a lot of that gets trumped just by the delta in the valuation. Sometimes it is the home market gives you a 5 or 6 multiple, and here you get 40, 50 just to take an example, and I'm talking of an actual case. That is the level of difference.
So it's worth the trouble, if I can use that word, Mr. Shroff. That's what you're saying. And
very, very, very nicely put.
And also, is there? Have you looked at the number of companies we can look at? I mean, you did say all countries from around the world are here, right? In terms of business operations,
yes,
etc. So have you done any kind of exercise which potentially puts a number to that sort of a figure there?
So I think what Raj said, I think we are all involved in a couple of conversations every month. And all of them will make a visit to Raj and to me. But we're not going to talk names here.
Okay, no, absolutely. Fair enough. Confidential conversations. And of course, we'll know when we know.